Good morning, sir. Gary. Nice to see you, sir, again. So sorry for keeping you waiting. Mhm. So it's a long day. So yeah, we lost around 14 minutes. Okay, as
Yeah.
promised. But you have enough time to present it. And so let me give a quick round of introduction for Mr. Gary Cokins. So we are talking about analytics-based enterprise performance management today. Gary Cokins is founder and CEO of Analytics-based performance management LLC and globally recognized authority in enterprise performance management, activity-based costing, and business analytics. With a career spanning financial control, operations management, and 15 years of consulting at Deloitte, KPMG, EDS, brings a deep industry expertise. His 16-year tenure at SAS further established him as an influential author, thought leader, and international speaker in EPM and analytics-driven decision-making. So Gary specialized in designing and implementing integrated performance management systems, including ABC and ABM, balance scorecards, strategy maps, customer value analysis, and risk and supply chain management. So thank you, sir, Gary, for joining the session, and eager to listen to you again. So thank you very much.
Okay. Thanks you. But I'm having difficult sharing
Yeah,
getting to my PowerPoint.
you have it in the bottom. You have four buttons. So the third one is the sharing button.
Yes, I have that. I have three columns: Chrome tab, window, entire
Yeah.
screen.
So go to the last one, entire screen.
Okay.
Then you click on
But
the window, whatever you see it. Your screen, you can just click on it, and then the share button will be activated. Yeah.
no.
So now we are able to see the full screen for you. Now you
Yeah,
can share.
but
Mhm.
how do I get to my PowerPoint file?
Yeah. You open the presentation. Yeah, open the presentation now in the bottom. Your regular PowerPoint presentation. Yeah. Yeah, now we can put it in the slideshow.
Wait. Can you see the landing slide?
Yeah, I can see that. Mhm.
Okay. Can I go to
Yeah,
slideshow view? Can you see that?
yeah. Yes, fantastic. We can see the full screen.
All right. Let's get going. Because I'm running a little late. I've put that, and you gave me 60 minutes.
Now you do it, sir. Yeah. You can take your complete time. No problems. Yeah.
Okay, I'm in say Eastern Standard Time, so I'll try to. I'm at 8 o'clock. I don't know what
Mhm.
that time is in India,
You take your time.
but
Yeah, you take your time. Yeah.
thank you. There will. It's a longer presentation, so there will likely be no time for Q&A questions at the end. So those who are listening to me, if you want questions, see my email address, gcokins at Gary Cokins. Just send me your questions and I will reply to you. Also, if you have a website, below the horizontal tabs are lots of articles that I've written. They're all free. You don't need anything. Okay, let's go. Who am I? Well, Sheikh Abdul introduced me. Cornell University, 71. If you're doing the math, I am 76 years old, but I think I'm 46. Why are those there? I believe that careers have much more to do with circumstances than being smart. Breaks one in 98, KPMG, where I was a recruit with Harvard Business School professor Robert S. Kaplan. Many of you know that balance scorecard to train KPMG consultant on activity-based costing. I recruited, I implemented for 5 years. I wrote a book, one of these books, and the rest led to writing more. You do not need to purchase my books. I don't want you to be criticized. Oh, this guy's promoting his books. No, I am not. If you go to Wiley.com, chapter 1 in there is a free download. Get the summary from there. All right, let's go. who will benefit from this presentation? Professionals who have previously struggled at promoting financial planning and analysis, FP&A, enterprise performance management, integrating business analytics into support systems. Who intend to champion any or all EPM and business analytic improvement techniques, and they need a call to action. And the reason marks, it's been my observation that although it's nice for the senior executive team to advocate the new ideas, often they are preoccupied with short-term priorities and firefighting. So typically managers 1, 2, 3 levels down in the organization, possibly of some who are listening to me, to basically demonstrate to their with a pilot project or a proof of concept that this is a go to use these progressive methods. So my agenda is going to clarify the confusion and lack of consensus. What is enterprise performance management? Similarly, to say what's business analytics? Describe 8 pressures that have interest using these methods, and then at the end I'll bring it all together. But I will go through several of those 8 methods in more detail. So there is confusion and lack of consensus about is it human resources performance management. You just do an internet search on just the 2 words performance management. It'll be about the personnel and HR function, employee appraisals. It's much broader. There's scorecards, dashboards, KPIs. Yes, but that's a subset. The executive team strategy with that. Is it process productivity and quality improvement? Lando, lean management, Sigma quality, cycle time reduction. Yes, but that's a subset. Or is it all of the above? And the good news, all of the above. But the problem is organizations that implement these methods, they implement them in isolation of each other. So you've got planning and budgeting people one part of the bill. You got risk management people in another part of the building. You got doing profitability reporting in another part of the building. You get a lot more power and energy when you seamlessly integrate all of these methods like gears in a machine, and even more power when you analytics of all flavors into them. So I will be sending Abdul this PowerPoint PDF later. Get it? You can read the definition that I just described. So let's move on. What is analytics? I always say work backwards with the end in mind. In other words, regardless of how analytics should be defined, and I could put a Wikipedia definition here, there should be no argument what purpose of analytics. It's 2 things: better decisions, better actions. Analytics should be to gain insights and foresight and solve problems to make better and quicker decisions with more fact-based data and to take actions. I said I wouldn't give you a definition, but that last paragraph at the bottom is a pretty good definition. Now, I have authored one of my books on predictive business analytics, co-authored it. The link is in that slide. Let's talk about the analytical continuum. Think of it as stages of maturity. We start with historical view, just analytics, pie charts, histograms. Then we move to diagnostic ones. Notice there's that black dot on the curves. So that's an outlier. So we want to drill, see what that's all about. Why is it an outlier? When we go to the future, we start with analytics, forecasting, and then at the very high end, I call it Mount Everest, is descriptive analytics, which the operation has caused interest in EP in the last 4, 5, 6, 7 years. Quickly, the first one is executives' frustration with strategy failure. Most executives are quite, excuse me, at their strategy. Their frustration is failure to successfully implement the strategy. And there's empirical evidence on this. There's a executive recruiting Chicago, and I was raised in Chicago. Go Bears! That's a NFL football. They monitor the involuntary turnover of CEOs in North America. The firing of CEOs is increasing every year. Example is Carly Fiorini at Hewlett-Packard. Director gave her a few months. She didn't implement. They fired her. Increased accountability. Today, there's no place to hide. Employee teams will be monitored. They will be measured. It doesn't necessarily mean their job is at risk, but it could impact their salary and more rapid decision making. Unlike a few years ago when you could test and have meetings and conference rooms, today people are on the phone. Go yes or no. They have to make a decision in real time. 4, distrust of the managerial accounting system for transparency and accuracy. The reality is most managers do not trust the costing system. Why? Those overhead allocations that they know are misleading. I will describe later how activity-based costing resolves the problem. 5, poor customer value management. The reality is customers and the actions with customers are the source of financial wealth creation for owners and shareholders. With customers all the way to the consequence of more money and profit for owners and shareholders. 6, contentious budgeting, poor resource capacity plan. My observation is the budgeting process is broken. Recommendation is saying, well, I brought your attention, didn't I? But what I'm going to describe is what was the purpose of a budget in the first place, and can we replicate and satisfy that using these corporate performance and enterprise performance management methods. 7, management. The reality is most customers view their supplier as the enemy. It's an adverse relationship. Oh, let's negotiate a lower supplier. If we put them out of business, so what? We'll just get another supplier. That behavior has to stop. It needs to be a marriage. Chains are competing with other supply chains for share of wallet and purse. And finally, unfulfilled return on investments from large IT systems, enterprise resource planning systems, ERP systems. Here is when you ask the director, after they've gone through 2 or 3 years implementing that complex ERP system, you ask them, how well do you believe the return on investment has met or exceeded? Where ERP software sold you on 2 years ago, they'll say, I'm not sure. We've put in a lot of time and I'm not sure we've got the benefit yet. Does not mean you don't implement ERP systems. You have to. You've got to basically stay competitive. The problem is ERP systems produce a lot of data, not necessarily information, and they're not the same thing. So what we want to do is convert the data information, and that's where the EPM systems like create the ROI like seeds from the ground. So I'm now going to drill down for about 40 minutes into these, the 8. The first one I already mentioned, failure by executives to execute their wealth strategy. So here's a little bit of a primer on the Kaplan and Norton strategy balance scorecard. You'll notice that the strategy into the balance scorecard. Many people say, well, we implemented a balance scorecard. I asked them, did you start with a strategy map? No. The strategy map is times more important than the balance scorecard. The balance scorecard is, and I'll show you an example of it in the next slide. But above those are something arguably an mission statement. That is the responsibility of the executive team. That's their job, to set direction. But the vision and statements answers is this question: where do we want to go? But the strategy map and the balance scorecard answer a different question: how will we get there? The balance scorecard, they're mechanical. They help realize the vision and mission of the executive team. Here's a fictitious example of a strategy map. What Kaplan and Norton recognized, and when they created this, is that executives were overreacting to financial reported at the end of the fiscal period. They said you need to shift your attention to non-financial metrics collected during the period, and then basically focus on improving to produce the financial results. The second reason they created this is most management teams and managers don't understand strategy of the executives. I mean, maybe your organization, and in the hallway, I randomly interviewed 10 employees. Quick, can you explain and articulate your executive strategy? How do they do it or do it well? None. So what Kaplan and Norton perspectives that go from bottom to top, learning and growth, and these little rectangles, these are strategic objectives. So you go from learning and growth objectives to the internal improvement ones, then further up to customer and loyalty objectives, ultimately arrives at the financial objectives, typically 2, 3, or 4 strategic objectives. Those arrows, those are the metric performance indicators, KPIs. You get what you measure it, you can't manage it. So to sort of bottom of the top, a learning environment stimulates process excellence, customer intimacy, loyalty, retention, and that creates the financial wealth for the shareholders and owners. To think about this is, imagine if every employee and manager every day answer this single question: how am I doing on what is important? Am I doing on what is important? The strategy map's balanced scorecard provides the answer. The overriding purpose of a strategy map and the balanced scorecard system is to make every job. It's almost like owners out of the employees. Let's move on to the fourth one: mistrust of the managerial accounting system and its flawed cost allocations and missing cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And this is ABC solves this. So here's my simple way to understand ABC. Imagine you go to a restaurant you order a little salad, the other 3 order the most expensive item on the menu. And when the waiter or waitress brings the bill, you say, hey, let's check evenly. How do you feel? Not fair, not equitable. Well, that's how products feel in a standard system when the accountant this large amount of indirect expense, commonly called overhead, and they allocate it to the products using cost allocation factors like labor hours, number of units produced, square feet, square meter, number of employees in a cost center. None of those cost allocation factors, the true consumption that the product we consume of the end-to-end business processes and the work activities that belong to them, which in turn then on the expenses, salary, wages, supplies, and so forth. The simple definition of AB is as if the waiter or wait for individual checks. You pay for what you consume. And when do that butter spreading compared to ABC, they discover that method, some of the products were way overcosted. The others were way undercosted because it's a zero-sum game. And so ABC, like a pair of glasses with the lens. Now, the reason there's been interest in ABC over the last several decades has to do with this diagram. It has the 3 universes of any organization's expense and cost structure. At the bottom, you've got the direct labor, the direct cost, direct material in the middle, the overhead at the top. Notice that as time goes by, the indirect expense overhead is displacing in magnitude. And when you ask people why, they'll say, well, computers, automation, robots, we're automating out frontline workers. That is a secondary explanation. The primary reason for this is over time, all companies have had an increased proliferation of different types of products in manufacturing, more colors, more sizes, more ranges, and so forth. And the point here is that when you increase the diversity and variation of the outputs, and the complexity requires more and more indirect expense overhead to manage it. Years ago, to the left, when homogeneous products, maybe you did black, red, white pens. That's all. The indirect was if you could allocate it, spreading the butter. You didn't introduce that much error. But now look to the right. Let's say we have 50 colors of pens. It's much more complex. We need to trace and assign it. The problem actually begins with this left diagram that everybody recognizes: a responsibility center cost statement, salary, equipment, travel, and so forth. The problem is, though, when managers get this kind of report, they're either sad, but they're rarely any smarter. So what ABC does, first, now look to the middle, it's the same 900 and 1400 US into the language of work. Key scan claims, claims. Notice I mean back office of a insurance company too. So ABC is universal, can apply to service organizations as well. And then we read those activity costs into the products, just like the waiter or waitress restaurant, based on the consumption. So it's basically, now I've rotated the previous diagram 90 degrees. It isn't as simple as, we take our expenses for the departments, we trace them to the work activity, and we reassign them to the cost objects, products, and services. The right side is more high. It's multiple stage, because we have support departments that ultimately support the frontline departments that interact with customers and make multiple stage. Now, I'm going to warn you, the next slide will look at it, but below it, the next slide after it, I will give you that you can read more slowly, leisure, how this slide works. Not complicated. We've got the resources at the top: salary, phone, depreciation, so forth. We have the work activities in the middle, and they eventually pile up. We call them into the final cost: products, services, and customers, and what's called business sustaining. Now, all of those arrows, think of them as wide pipes where the amount of money flow basically. So if this organ spent, let's say, 5 million euros or whatever the currency in January, it'll be the exact same 5 million of these, and they will pile up and accumulate in bottom boxes, customers and business sustaining. You're asking, what is business sustaining? There'll be some expenses that have nothing to do with interacting with customing products, legal, or when the accounting department is closing books, they're not traceable. So we park them into a cost object like senior management. Senior management wants the reports. It's typically 5 to 10% of the monthly expense. This is all traceable. Also notice in the middle, we have PPs and equipment activities. Men and women run machines. Machines make parts. Equipment, the machinery, also has activities. The message here is costing is modeling. Costing is not T accounts and journal entries that account. You need to model function relations. At the bottom, reverse all those arrows in your mind the other direction, going from bottom to top. That's what's happening every hour, day, week, month. The customers and the products are placing demands. Load is drawing on the spending, the cost or the effect in the other direction. Also, notice that there are a couple of arrows from the red boxes going directly to the customers, what we call cost to serve activities and costs. So things like channel distribution expenses, marketing expenses, selling expenses, And this will allow us to create profit and loss for each. I'll show that in a few minutes. Again, I went through that quickly. When you get these slides, if you go to the link at the bottom, it's an article, it's a paper I wrote for the Institute of Management Accounting. I'm a 30-year member of that, and I had them. They asked me to write that statement on management accounting. What's the result when ABC? You're looking from a real company axis is the net revenues minus the properly traced and calculated ABC costs. The horizontal axis is the cumulative buildup of the profit, but it's rank order starting with the most profitable products, profitable product, and so forth. The very last data point at the right will exactly reconcile with the profit and loss statement. So for this organization, for the quarter, at 30 million in sales, 28 in expenses, and 2. Last data point is the 2. This organizational shock to the employees and managers and executives when they see it, referred to as a whale curve. It looks like a humpback whale. Notice in this graph of this real company, they made roughly $8 million of unrevealed by the ABC calculation, but they lost $6 million. The remainder to net out a 2, and they can't, because that flawed butter spreading on labor hour creates the blue line. So the blue line says almost everything except for a few at the end is not true. That broad brush averaging, butter spreading, I call it, is crushing and suppressing any accuracy. That blue line is wrong. The black line is correct. And some of you may ask, well, what do you do about all those products? No, do them? No. Some of them may be at their early stage product development. So it's a shakeout period, sales volume, but it'll eventually migrate to the left and be profitable. But it's fact-based data. Anything from my presentation, remember this. In the absence of facts, anybody's opinion is a good one. In the absence of facts, opinion is a good one. But usually the biggest opinion wins, which is the opinion of the boss. So to the degree they're making decisions on real intuition or flawed and misleading information like the blue line, the organization is at risk. Let's move on, or let's go further. We're using ABC going below the product gross profit margin centric. The only value a company will ever create is the value that comes from its customers, the current one and the new ones acquired in the future. To remain competitive, determine how to keep customers long, grow them into bigger customers, make them more, serve them more efficiently, and acquire relative customers like the ones you have today. But we have a few problems here. The accountants are or measuring customer B. They're stopping halfway down the profit and loss income statement at profit margin, including channel distribution expenses. So the entire record was the expenses for the organization. The accountants are only calculating the shaded area. And it'd be nice if for the indirect overhead they were using ABC, but they're not including the white space. ABC can continue to do the space. And why do customer-related costs matter? As differentiation from the product advantages is reduced or new. In other words, as competitors match your product's differentiation, so you don't have the differentiation edge, competitive edge from your products, then the relationship grows in importance. Thus, the cost to serve component of each customer's requires measurement and visibility, and activity-based costing measures how resources are uniquely consumed each diverse customer. So here's the problem. We've got what I call angel customers and demon customers. What I mean by that, I mean, every company has high and low maintenance customers. So example, high maintenance customer, always changing the delivery schedule, always demanding special, not standard product, returning goods, calling help desk. Low maintenance ain't the demons. Low maintenance customers, they love them. They don't do any of those, always meet delivery schedule, never, always standard, never return goods. The mirror is that sales volume is synonymous or equivalent of a customer. What's more interesting is the subtopic, discover which type of customer is which and turbocharger stock price. So now we've connected customer actions behavior to shareholder wealth and owner's wealth. It was authored by two faculty at Columbia University in New York City. It doesn't talk about, but it gets the point across. So to really firm what I just described, unprofitable customers are distinguished by how they place demands on parties. The less profitable customers, okay, the demons, small order quantities, special products ordered, the price discounting, unpredictable time is changing, high technical support, that's indirect, slow payment, bad. The good customers, large order size, only buy standard products, little price no price discounting, very predictable demands, low technical support, maybe no technical support, and they pay on time. This behavior can be measurability based, and it can produce an income statement that looks like this. It's and this is a fictitious customer, but notice the profit contribution at 30% for the products is margin. But between the 30 and 8, 22 more profitability are eroded, nothing to do with making the product, but all the interaction with the customer. And if we cut swaths for every customer, put them into a graph grid that looks like this, where each circle into intersection is a customer. Now the vertical axis is the product mix gross profit margin. And horizontal axis is that cost to serve, the angels on the left, the devils on the right. Now things become obvious. The customer, because they're buying a low profit mix from you and they're difficult to serve. The most profitable customers upper left, because they're buying high gross profit margin and they're easy to serve. And now the name of the move the dots, move the customers from the bottom upper left, and that would be a whole other seminar person to describe how do you take. But one action you could take be fee-based charges. So when they ask to do things, have been charging for baggage, or if you want to change it to an aisle seat, charge them an extra fee, more profitable. Now, some of you may activity-based costing sounds like it's too. My understanding is complicated. It's too big. It doesn't work. It takes too long to implement. And so those are all misconceptions. But they weren't misconceptions several years ago. A lot of ABC, sometimes even the consultants didn't know how to implement it. I then came up with a technique that you can implement an ABC system in 2 weeks, not 6 months. It starts with what we call rapid typing with iterations. We start with a 1-day workshop, 4, 5, 6 cross-functional employees in a room, build a high-level ABC very quickly, not intended to be accurate, just to basically show the design. Then the next morning, bring in the executives, some of the other line managers. They see what was constructed by these 5 people. Very engaging because it's your own company. The light bulb on with everybody. Oh, that's how we get rid of that butter spreading of labor hours. Oh, that's how we validate whether our pricing was profitable or not. Oh, that's how we can do benchmark apples and oranges and so forth. Then a couple of iterations for several, you get to a permanent, repeatable ABC production system. It can be done quickly. Make your mistakes often, not later when the system is changed. All right, let's move to budgeting. I said the budget is broken. The budget is typical fiscal exercise that's done by the accountants that has two problems. It's disconnected from the executive team strategy, and it's not really based on future driver volumes. Now describe how corporate enterprise performance management methods, these gears in the machine that are in, can resolve this. But first, let's look and see how you're doing it. How many of these apply when your company or organization does budgeting? It's invasive and time consuming with few, it takes 6 months from beginning to end. You start in July or end in producing it in December. It requires 2 or more executive tweaks at the end. The executives don't like the first draft of the budget. They want changed numbers. It's absolute events and organization. So you produce and report the budget by March, it's already out of date. It's departments with truly valid needs. Let's say in the next fiscal year, there's going to be a department of work towards them. We didn't give them more of that. It caves into the voice and political muscle. That's from those years, the ones that have been in the company for 15, 20 years. They know how to game this, which means we reward them. They're what I call the veteran sandbags. They know how to basically work to their proposing for their budget just in case it goes wrong next year, and they've got cushion. Next, last year's inefficiencies into this year's. The process was ineffective. We replicate it this year. The last one bothers me a lot. When a manager is 2-3 months from the glide path, 2 months from the end of the fiscal year, not going to spend a budget that was approved and allotted to them, what do they start doing? Spending needlessly, foolishly, because they know that next year's budget them be pegged to how much they spent this year. Now let me see if I can how you do budgeting in your organization. You give each manager a cost center department sheet in December with the basically general ledger accounts, including rubber bands and paper clips. Each of them fills it out. Someone then in the accounting department consolidates all the spreadsheet, and they bring in a forecast department to basically produce the profit and loss statement. You give it to the executives. They look at that. They say, not enough profit. Have them change some of the numbers, lower some of those expenses. So all the spreadsheets go back to the managers. They lower some of the expenses of from their ledger accounts in the accounting department back to the executives. That's a little bit better, but not good enough. Down, up, down, up, down. Come on. We almost want to ask the executives, what number of profit level did you want in the first place, so we didn't have to go through all this spreadsheet manipulation? But that would the aspiration and desires of the executives what's really possible. So how does enterprise performance management satisfy? We don't do this spreadsheet budgeting. We do it a different way. We consider that the amount of spending in any period is a result of 2 rivers coming at the organization. The upper river stream is the recurring, repeatable expenses. And it's going to be demand-driven. Think of the sales order demand. The bottom river stream, the non-recurring, non-repeatable expenses, and they're coming from projects. And I'll give you an example what those projects, look like. So when we do the upper river stream, the repeatable work, we basically do a capacity report plan. I'll show you that in a second. We calculate the ABC model backwards. We bottom, we forecast and predict what the drive predictive view to solve for the level of resources. So in other way to the historical view, the and we use ABC to calculate the work products and services. Okay. And that's primarily for strategic intent. We want to see where our profit margins are, but we get a bonus when we do ABC, the unit level cost consumption. A typical ABC system will have 50 to 70 activities, thousands of them. Each of those 50 to 70 will have a unit driver cost, like cost per material forklift truck. Then, now that we've got the unit cost consumption rates, we calculate backwards. And I think it was my second semester freshman year at Cornell University Industrial Engineering, we learned this equation. The customer to mix times the unit level cost consumption rate is required. For example, the number of employees and their salary and wages, and this is with suppliers. So you've got to think like an engineer. I've been involved in the CFO and accounts. They age 27. I'm 76 now, but at age 27, I wound up being a division controller for a large manufacturing conglomerate in Milwaukee. And that's where I got a wake-up call when I realized, hey, this is not about external financial report for statutory and regulatory agencies. It's about internal management accounting for insights and better decisions to all of you in India. The problem, and I have been to India several times, Bangalore, Hyderabad, Chennai, Mumbai, I think I've been there times, is your accounting emphasis is too much satisfying regulatory agencies, your government agencies. You got to the side, they're secondary. It's more important is the internal management employees in your organization. They deserve much better information. I hope I don't get in trouble now for saying basically critical things about the government in India.
No problem. No problem. Yeah.
Now let's go to the lower ring, the non-repeatable work, the project-driven. This is a diagram involving the risk management community, and it's a popular diagram they use. Each circle is a type of risk event that can happen in the future. The matter is how much money would be spent to mitigate it. The axis is the severity of the event occurring. Would it be? The horizontal axis is the event occurring. Now, you can't basically mitigate every single possible risk, but those that are in the upper right do some risk mitigation. Now, I've decomposed the upper stream, lower stream into this diagram. Shaded boxes is the upper river stream. I won't go there now, but we start with the management ABC. That brings in a little consumption rates. From the left, we bring volume and mix. That gives us a capacity resource plan. How many employees, how many machines, how many labor hours, pounds, grams, number of employees. We monetize it to whatever is your currency, euros, dollars. From the left, now we've got three projects. We've got the risk mitigation projects. Go back to the strategy map and the balance scorecard. Remember the strategy map with objectives? To execute and implement the strategy, we have to pay for the project initiatives to accomplish it. So now we've got is now budget as opposed, and then you're all familiar with your capital to justify purchases of equipment and machines with ROI. So when we bring them all three together, the operational budget from the top, the three projects, we get the derived, and that is much better than, remember those spreadsheets, up, down, up, down. Now, because the budget typically is out of date within a couple of months, we can do is refresh the relations, and there is software that can do this by reforecasting, because any forecast is going to be out of date within so we reforecast, and we run it through all of the same calculations. The only independent variable in this is the forecast. Everything else has been calibrated or can be derived. So this is what you're seeing is capacity sort of driver-based budgeting and forecast. Now, notice at the bottom right, there's a diamond. We still have a similar problem with trading. When we go through these calculations and give it to the executives, say, not enough profit, go change something, lower something. Well, the temptation would be, well, why don't we eliminate or postpone the risk mitigation spending? Bad. Then we expose our risk. What if we strategic project spending? Bad. Then we not execute the strategy. What if we eliminate or postpone? They justified them. The only way to really lower the expenses is the unit level consumption rates, which means product improvements. And that's where lean management, Six Sigma quality, reducing cycle time comes into play. Now integrated the process view, the operation people with this entire exercise. Now, you need to basically think like that, because in the descriptive view, that multi-stage cost assignment, we're primarily calculating costs. But predictive view, you have to classify the behavior of the resources as sunk, fixed, step fixed, or variable. And you'll notice in this diagram, as time goes out, as the planning horizon goes out, things become more variable. For examples, we may replace full-time employees with temporary workers, or we may lease assets that we would have normally purchased. When we lease them, paying on them on a monthly basis. When we purchase them, stuck with depreciation. So you've got to think like an engineer. And most accountants, and I'll just make an observation, they're not or understanding what I would call microeconomics, classifying the behavior fixed, variable. They're really good at basically bookkeeping at the end of the month, producing period math. Okay. So how does it all fit together? How does it, what I call enterprise performance management as a value multiplier by income? What I'm showing in this diagram is how together. So let's start with the big purple box, that's organization resources. That's going to be all of your employees and your assets. Okay. Let's start again, look at the customer loyalty. The customer have black line going up over to the right. We want it to the shares. I mentioned earlier, customers and our behavior with customers, the source of value, wealth, financial creation for shareholders. We want an action. Now, how does the diagram work? When we go to the strategy and mission, it's going to be derived by how do we go customers and make customers more. Then communicate to our managers and employees with KPIs, and we'll set target on the KPIs and distribute that to managers. That's where account, because now it's kind of like the mule and the donkey with the carrot, trying to eat the carrot. Manager is held to current KPIs, and they need to try to meet or exceed. And that provides back. Once we report the balance scorecard monthly, let's say, feedback to the, how am I doing on what's important? Now, let's go from the customers. I have CRM. The message there is, and marketing are always asking which type of customer is more attractive to retain, to win back, or abandon? Which types are not. That's where they need customer profitability. Now let's look at that. The count blue. This is where the process people come into. The most prominent end process in any organization is order fulfillment. Take the customer order, complete the order. So it is in that area that the process stated to basically reduce cycle time, reduce waste, and so forth. Management accounting and analytics in my diagram, I deliberately left it out because the output of accounting and analytics is pervasive. It's an input just to everywhere. You use management, the language of money to get insights to make better decisions. Now I'm decomposing the diagram more. So start at the customer satisfaction to the left. The executives will fit strategy based on needs of the customer. They'll then communicate it downward with the risk management strategy, KPIs. That gives us the scorecards and dashboards. That then from there to the right, it gives us the feedback. Remember, every employee can answer the question, how am I doing on what's important? But if every employee answer that question, then how are we all doing on what's important? So that's all to support strategy execution for the executive. Now we got that targeting, of customer we're targeting. Which type of customer is more attractive to reach, to grow, to win, acquire, which are not? So that's where the customer profitability comes into play. And then we've got that order fulfillment, the clockwise circle. The customer complete the order more efficiently. All of this will create more money. Now you should bubbles through these veins. This is an entire system, like your heart, your blood system. Any of those veins are, I refer to it as arteriosclerosis of the EPM system, term arterial, which produces heart attacks. If any of those veins too thin, it's going to basically restrict how the money flows through. So it go all the way to the shareholders, it leaks to the sewer. If we're basically the wrong types of customers, if our processes are inefficient. So I'd like you to think of this whole diagram in your mind as the vision of what have happened in your organization. Here's a key. We need good leadership. We need leadership that can prioritize. So once that's the next step for them is where do, well, they have to ask the question, if we do or we make or lose, because we have the flawed cost accounting system, let's do ABC, activity-based costing. If we're not measuring the right things, we don't have the KPIs, let's start with the strategy map and balance. But my message here is don't 2 to 3 years to implement. Try to get them in 3 months or 6 months. Use the rapid prototyping, with iteration. Start small, big, move fast. So that's my picture of what really a full vision of an EPM system should. Now let me share with me. Why has the for analytics EPM has been so slow? I have empirical that when it comes to activity-based costing, 90% of organizations that should be using ABC are doing it the traditional way, not changing. And there's several reasons that are barriers and obstacles from change categories. Why is the adoption rate so slow? What are their categories? The first one are technical barriers, and they include IT, information technology related issues, such as bad, dirty data. Someone put in mistake. It's giving us flawed, but the information IT department has a tool that can pure data. It's called extraction, transform, and ETL. And let me give you an example. Let's say that you're a large conglomerate, probably, let's say, Reliance. You want to negotiate with a big supplier like negotiate lower price because of our volume. But all of the different divisions have a different vendor master file. So for one division of Reliance, I'm just using them as an example, General Electric, and the master in the vendor file is G. In another division, they've got General Electric spelled out. In another division, they have ENL, abbreviation. What extraction, transform, and load is to look at, collect all of those, and select a standard, basically unify on, let's say it's general, it'll go back and replace them in all of the other files. And now the people at corporate headquarters, they're the one who are going to do the study to negotiate the lower price sales volume, can see the total system. Another technical barrier with IT is you may have different hardware. You may have Dell, you may have Hewlett-Packard. IT can fix that. The problem is the perception barriers. It's too complex. ABCO, it'll take us 9 months. It'll have 5,000 activities, so forth. I demonstrate ABC system can be implemented in 2 to 3 weeks using prototyping iterations. But the biggest problem, 3, it's got nothing to do with tech, to do with systems, nothing to do with it's organizational behavior, and it starts with resistance to change. It's human nature. People don't, fear of other truth. Oh, I don't want to do an ABC system. I don't want the other managers to know what my expenses are. Being measured, accountable. We ship there. I said it. Not every executive team's got the highest IQ. So the real solution is you need soft skills of behavioral management. Now, most accountants, like perhaps then there are no accountants in the audience. I'm usually presenting to accountants. I say, you've got those hard skills. You know how to do a fiscal month-end close, and you have debits and credits and journals and all that. You need soft skills. Most of you, and maybe this even of those of you listening to me, you are what I call Newtonian managers, like Isaac Newton, the physicist. You, the world machine. Give me the levers, the pulleys, and dials. What you need is Darwin, like Charles Darwin, the biologist. You need to learn how to basically overcome, resistance using change management techniques. Conclude with what I call the complete vision of performance management. It's a cover of actually one of my books, and in there I have these broken gears, teeth are broken, it's inefficient. To the right, spinning revolutions. Current state for many is with the broken gears. There's flawed. You put that in your automobile. What would your fuel if very low? Now put the titanium gears into your automobile. What's your fuel efficiency? Very high. It's the metaphor of fuel efficiency with the rate of shareholder wealth creation. So you want the revolutions per minute of those corporate performance management, business analytic gears spin better, faster, cheaper. That's the process improvement, safer, risk mitigation, smart scorecard. So I'll conclude. Action steps to educated. Thank you. You're doing that by listening to my presentation. Get buy-in from those that are going to be impacted. Prototyping. Think big, go fast. I don't have expertise in motivational theory, but I know important whether it's commissions and like you get these slides. There are links to as many as I covered. Your success depends on how the information intelligence gets to the right people. So Abdul, I have
Yeah.
concluded. Thank you
So
to
thank
the
you very much.
audience.
Thank you very much, sir, for wonderful lecture. Each time I hear, I learn something. Okay. So this fantastic session, ladies and gentlemen, give a big round of applause to Gary Cokins. He's he's the name to be looked for enterprise performance management globally. So very well known and very kind to share the knowledge with the global manufacturing summit audience. So thank you, sir, on behalf of the entire participants and organizers. Thank you very much. Sincere appreciations to you and your time. So it is a pleasure listening to you again and again on different topics. And enterprise performance management is something close to your heart and our hearts also. So thank you very much. And I take this as an opportunity to conclude the session. And any questions to Gary, please write to us. And he is very much available in the LinkedIn. If you post any questions, if you need help, any advisory service to implement activity-based costing or activity-based management, Gary is available to help you. And there are some fantastic books on activity-based management and enterprise performance management. You will really love to read them. So enjoy and have a great time. So thank you very much, all the participants, for joining the session. Thank you, sir, for a wonderful lecture. Sincere appreciations on behalf of everybody. Thank you. Thank you very much. Yeah.